The market is cracking right now. Volatility is surging, sellers are panicking, and most investors are wondering how far will this fall go. But here's the truth. Some stocks don't just survive crashes, they make money during them. And today we're bringing you the insight that only decades of real market experience can give, backed by an AFSL license and Australia's leading accredited trading education program, to reveal 3 ASX stocks with a proven history of not just holding up, but actually creating opportunities while the market is falling. If you want to know where the money flows when everything else is selling off, stay tuned. These are the crash resilient stocks that could put you ahead while everyone else is behind. I'm Philip Tortevsky, and joining me is Wealth Within analyst Pedro Banales. Good evening, mate.
Good evening, Phil. Everything seems to be doom and gloom in the news lately, right?
Yeah, look, the market's falling at the moment, but I mean, this is the perfect time to be looking at these crash-proof stocks that we're going to get into right now. So let's dive straight into it. And the first up, we have Telstra. Now, I mean, Pedro, this stock is a company that, and that's the thing, when we're looking at these 3 shares, I want to make it a note that these are companies with a really sustained long-term, earnings and stability, which has survived recessions and all that kind of stuff. Now, when you look at the share price of Telstra, it has been up and down, which is why it makes it so exciting to me, because you're talking about a company where people use the word moat loosely, but Telstra is, when you're in that spot, I'm just trying to bring this up a little higher, but you look at Telstra today, started off with its IPO, that initial euphoria. It's not been great since the 2000s. In 2010, it found a turning point. But if you look at a big picture with the dominance that the company does have, and we zoom the, price marker on here, and you look and the share price is still trading 45% below its all-time high, really just close to that IPO price, only around, I think we're looking at, if we go from IPO price, it's only trading about 20 to 25%, 20% above the IPO price. So for those value type opportunities, if you're asking the question, is it too late for a stock like Telstra? Well, not really. It's definitely not in an Nvidia type situation or a Palantir situation that's running through the roof, or in a sector that is highly volatile like the tech sector. This is a sector that holds up well during downturns. And if we are going to move into a prolonged downturn, these 3 stocks you're going to see today, they're the ones to be looking at for me for opportunities. And it doesn't mean buy and hold for that matter also. It means where are those nice opportunities to extract profit. And I guess right now we're coming off this really nice base. I mean, these lows have been so important for Telstra in 2010, in 2018 and 2020. Anyone who is versed or has done our courses would know how important these unfoldings is, or what price is doing now in terms of what's expected next. And I really like the fact that we've held that $4 level. That's provided, a new base for the stock. So I'd be keeping a close eye on that. But we've accelerated away now. So I think Telstra is in a spot where looking for an opportunity is the wise thing to do. But for me, where it's at $5, I would like to see the stock potentially have a bit of a breather and come into this strong buying at around 430. If we can do something like that, potentially get back into these levels through here and, retrace nicely into the 430 level, somewhere through here, I think, and show some bullishness following that, I think Telstra's got a real chance of breaking into $6 within a couple of years. And to me, that is the promising part with it right now. But again, it's all about lining up that risk-reward opportunity. That's the only reason I say where it is today potentially leans itself more to a short-term opportunity. But again, if you look at the price action that we're seeing right now, and I'll just fix this up so you can have a good look, but we've struggled at $5. We struggled back in September 25, and this is the month of November. So far, you can see we tried to push through, but closing under it. So I'd be watching $5 closely. The better option is if we pull back, as mentioned, to around that 440, and then look for that next opportunity, potentially somewhere on this rate of rise that we're seeing now, which is through there. So if we get something around 440, that would be quite nice for me with Telstra. But again, I love the fact that it's in a sector. I love the fact that it'll hold up with its stability, the way the business is set up, with what comes if we do move into a deeper pullback for the All Ords and globally.
Absolutely. I mean, look, what I like about Telstra is that ever since 2018, and you can see it clearly on the chart here, it has evolved from just being a telecommunications company to being a techno telecommunications company. I mean, and they're in multiple things. They're in IoT, they're in connected devices. Of course, there's internet. they are a crucial and essential company for Australia. You can't deny it. Even other retailers use their towers. You know, they lease out their towers. So that's the story. They're actually cemented themselves quite strongly here in Australia. And that could have been the argument while the stock is falling down. And of course, you've got the dividends along the way that people like. But it does show that you do need to be well-versed in technical analysis, because you do have to time these types of things. Just because it's a good company doesn't mean that it's going to be running up forever. But it does look, yep. So it does look like we are at that new cycle of that expansion. New type of services and offerings. I think that this one is great long term, and I would say almost fully crash proof.
Yeah,
almost.
And just at these levels quickly, you didn't mention, do you like it right now, or are you thinking?
I totally agree with your $5 analysis on that breakout of that sideways movement. If we're seeing a move up, then it's going to test these highs here at around $6, so $6.50.
Yeah. Bit of upside there. Great. All right, next up is APA Group, but the one after is the pick of the bunch for me anyway, so stay tuned for that. But now, Pedro, I know you're all over this one, APA Group. Yeah. Another stock in a sector that is, I guess, somewhat recession-proof, if you will.
That's right.
And the share price has kind of shown us that over the years, hasn't it?
It has, and it's quite nice, the price action that it's unfolding now. So for those people that don't know, APA Group is involved in gas infrastructure and pipelines, so very crucial. You know, gas isn't going away anytime soon, and it's actually going to be more and more important as we try to get off these fossil fuels. Renewable energy, unfortunately, no matter how much you like the story, it's not going to come into play anytime soon. We are putting in new, turbines and solar panels, but unfortunately we do have to upgrade a lot of that infrastructure for it to be of any benefit. So APA Group, I think, is in a great position right now to benefit. This long-term pattern that has unfolded here, I mean, it's just beautiful. It's textbook. Our advanced students doing the course, I mean, even our diploma students, you could have traded this using some simple rules out of module 3, basically, just as it's broken out of this trend. And now it looks like it's trading beautifully on a long-term uptrend. Now, it does look a little bit overextended at the moment. We could see a bit of a pullback. You can see that it doesn't always go, just fully green. You do see these moments of sideways consolidation. So that could be possible for the stock right now, and actually probable, I would say. But overall, like looking at the overall structure, I would say that these levels here, that's going to be definitely a strong resistance level around that $10 mark, and it's heading there now. But if we do see a bit of a pullback, and we'd have to probably go to the weekly chart to see, pinpoint those exact points. If we do see a little bit of a pullback, say to roughly, I would say anywhere between, I'll put the correct tool here, anywhere between that $8 to, $9 that is, to that $8, like anywhere around that range, I think that would be a good kind of entry if you do see some type of entry rule around there. So great long-term up potential. A little bit of a short-term pullback is on the cards, I would say. Yeah,
and I think what it shows, if I just go zoom back out to that monthly chart, especially for those people that think, technical analysis is not important. I mean, we've seen comments from people saying, well, price action today isn't relevant to the past, so why look at the past? But if I bring up this particular level, somewhere around there, at around that $7.80, and tell you that since 2015, it's been a level where the stock has bounced, it just proves that, hey, price action is repeatable, it is important, and that's why looking at the big picture of things is so valuable when you are looking at stocks like this. Because for me, when you look at APA, it has proven time and time again throughout history, albeit it does experience pullbacks. No stock is without a pullback.
Yep.
In fact, pullbacks are important for stocks to continue on, the rate of rise that is sustainable. And, when you apply a good view of what is sustainable for APA, well, it's generally along something like this. And why it's so exciting for me right now is because throughout history, we've had those pullbacks that have signified around that. I mean, from here, it's been, 50-odd% there, if my eyes serve me correctly. Then we've had further pullbacks, and I'm trying to pick the bigger ones for your viewing. That's 29 through there. The other big pullback was around the COVID period. We fell around 33%. And so today, we stand with the stock starting to reverse at a significant level after almost a 50% pullback. So we've done enough in terms of, the seller activity for one of these long-term, growth stories, stable growth stories that are resilient in periods or in market periods of downturn. So, it bodes well for big picture, longer term investing, but it also bodes well for those traders that are looking to capture profit. And I'm with you. I reckon $10 right now looks like a level to be mindful of. So weigh up your risk reward on things. And really, if it holds this $798 like it's been holding since 2015, you've got to assume that the potential is to the upside.
Yeah, I mean, it'll be a good retest of that level. And then if it manages to then break to the upside again, that will be definitely a good sign. So we'll be watching this one for sure.
Yeah, and if you want to get into a lot of the stuff we show on this show, it is the introduction. It is the book, How to Beat the Managed Funds by 20%. We're stocked up again. It's free. You just have to pay the shipping. See the comments in the video below, or the link, in the comment section in the video below. It's got a lot of the stuff we talk about. It is a very nice introduction into portfolio construction, all the things that are relevant today to be able to profit from the stock market. So if you do want to take things to the next level, as I often mention here, is go and visit the website and check out our trading courses, because that'll take you to a whole nother level. Wealthwithin.com.au is the website. Now, we do have the third stock, which to me is, I think, the most important one in periods like this when markets are crashing, and that is Cochlear. A stock that has proven itself time and time again, has a really distinctive moat, has a business model where once you become a customer, you're a customer for life, is working in a, tailwind of an aging population demographic that regardless of whether we have a recession or a crash or whatnot, people are still going to need an essential. As we get older, we get deafer. And we're getting a lot older. And
that's not selective deafness either.
And potentially a lot deafer, as the statistics are saying, about 800 million Australians are getting to that age where this is going to be important, which is why this company has consistently been able to produce with steady earnings in that, and it's also got 60% of the global market share in a space. I don't know what else I have to say about it in terms of why it's defensive enough. But,
well, for me, one of the biggest thing was that the barrier to entry, it's 15 years. If you wanted to establish a company to rival Cochlear, you're going to need the technology, the people that with the know-how to do it. So their barrier to entry is so big, hence why they've got such a huge moat.
And they spend more than anyone else on R&D.
So they're always staying ahead.
So
what more can you want? I mean, now all we need to see is a chart heading in the right direction. So
well, let's do it. Please take it away, mate.
All right. So let's have a look at that overall long trend that we are talking about. And you can see that ever since 2014, basically, this has just been on an absolute beauty of a run. Let's see how much it has done ever since 2014. It's done 300, almost 400%, 390 roughly, or 376 if you want to be precise around these levels. So it does look like it's coming down to that angle of the trend, but oh boy, I tell you, if it does bounce around that 260, which it does look likely it's going to happen, just seeing, these previous levels here where it's found resistance and support more recently, it's crossing over exactly nice and beautifully along that trend there. If it does find support around that $2.60 and then bounces off that, I'd be getting pretty excited, because it's only going to get, worse in terms of people aging. We've got the baby boomers now coming into age that, they're going to require these services as well. So the story is lining up, the fundamentals are lining up, and the charts are lining up.
And the potential to continuously profit with a bigger market or customer base is there as well. For me, when I just look at the chart, it just shows this is a healthy company. And what's the most exciting part is the fact that throughout the years, it's always been able to, like you can see, 04, new base at 34. 2009 to 2013, a new base at 72. From 2018 to 2022, found a new base at 200. And what's promising is that, yes, we've pulled back, but it looks like now the pulling back is slowing. And if we start to form new bases at around that 290, 300, that might be the springboard for the next couple of years leg up. And that, I think, from what you're saying, is quite exciting. Again, the students of ours would be seeing this happening in real time and being able to foretell maybe we're entering this kind of consolidation potentially by what we're seeing today. And I won't go into it too much, but if that is the case, that could be quite promising. And I'm with you. I mean, 270, 250, if it holds through here, that's going to be quite promising. I mean, CSL is another company that was looking this way until structurally they changed a lot of things and it's shifted. So that's why it's also important, more important than ever, even though this story has been the way it has been and it's got everything going for it. If we do see a break of this 250 level, you need to be mindful on the technicals to protect risk at all costs, because you never know, it might one day end up in that CSL bucket.
Yeah.
And things could change. But as long as you're on the charts, as long as you're monitoring price, I think you're playing the game much, much safer. And boy, this is opportunity for short, medium and long term, the way this stock has performed.
Definitely
and looking likely to perform. So this recession-proof tick, market dropping proof, you can probably put another little tick on there as well. And, now I think let's finish off with that one. If you want more hot stock tips, check out our video, 3 ASX stocks to buy, profit from the AI bubble before it's too late.